All right, welcome to this explainer. Today, we're diving into exactly how quantitative traders are pulling steady, predictable yield right out of the absolute chaos of crypto markets. We hear all the time about the wild, gut-wrenching price swings of digital assets, but there is an entirely different game being played right beneath the surface. It's a game defined by pure mathematics, where professional operators are locking in consistent profits without ever taking a directional bet on whether the broader market is going up or down. So how exactly does the smart money pull risk-free profit out of all that chaos? Well, we're going to answer that by unpacking a highly specialized financial strategy that demands absolute precision, blinding speed, and, believe it or not, sometimes literally zero upfront capital. We're talking about stablecoin arbitrage. This isn't about crossing your fingers and hoping a token goes to the moon. This is about ruthlessly capturing tiny, fleeting price discrepancies between different trading venues. Here is our roadmap for today. We'll start with the stablecoin refinery, look at the 5 paths to arbitrage, break down the cross-exchange play, dive into atomic flash loan mechanics, expose the systemic risks and predators, and finally look at bridging the asset divide. Okay, let's jump right into section 1, the stablecoin refinery. Look, we all know the crypto market is basically a storm of volatility, right? Assets like Bitcoin, Ethereum, and those wild meme tokens are just constantly shifting. But stablecoins, which are structurally pegged to fiat currencies like the US dollar, they act as these calm, intermediate reservoirs. Think of assets like USDC or DAI. Because they're pegged to a dollar, they allow operators to accumulate returns while almost entirely minimizing their exposure to those extreme market swings. There's a brilliant concept here. The real alpha is not trading, it's positioning. Arbitrageurs act as the pipeline moving value between assets. It's kind of like physical oil flow arbitrage. These operators aren't placing bets on price direction, they're simply getting paid to move liquidity through the pipes whenever tiny inefficiencies pop up. Just like an oil trader spots a logistical gap and steps in to control the flow between crude oil and a refinery, digital arbitrageurs route capital between volatile tokens and stable reservoirs. They aren't trying to predict the future, they're just exploiting the present geography of the market. Moving right along to section 2, 5 paths to arbitrage. Depending on market conditions and liquidity, there are really 5 distinct models used in this ecosystem. First up, exchange-to-exchange arbitrage. That's just buying at a discount on one platform and immediately selling at a premium on another. Next is triangular arbitrage, where you exploit pricing mismatches between 3 different stablecoin pools on the single exchange. Then you've got depeg/repeg arbitrage. This is where you capitalize on a temporary panic. Say DAI slips down to 95 cents. You buy the discount and just wait for the algorithm to snap it back to $1. Rounding it out, we have spot versus perpetual funding rate plays and default interest rate spreads. That last one is like earning a juicy 12% deposit rate on TrueUSD on one lending protocol while borrowing a cheaper asset on another just to pocket that net interest spread. Which brings us to section 3, the cross-exchange plan. Let's look at a really simple scenario to build our foundation. Say the price of USDC diverges just a tiny bit across 2 exchanges. On exchange A, it's trading at a discount, $0.997. On exchange B, it's at a premium, $1.002. You step in and buy 100,000 USDC on exchange A for $99,700. You instantly transfer and sell it on exchange B for $100,200. Boom! That is a quick, clean $500 gross spread, or 0.5%, with zero exposure to a market crash. But hold on, that $500 doesn't just go straight into your pocket. To find the actual realizable profit, fiduciaries have to apply a really strict accounting invariant. You have to deduct every single operational cost. We're talking exchange trading fees, blockchain network gas fees, slippage from the order book, financing costs, the whole shebang. Only if that net equation stays positive do you actually pull the trigger on the trade. Okay, let's step it up a notch with section 4, atomic flash loan mechanics. This is where things get wild. In decentralized finance, professional operators use what's called an atomic flash loan. This is essentially a perfectly legal digital heist. You borrow capital, deploy it, and repay it, all within a single blockchain transaction block. If you can't pay the lender back instantly, the smart contract completely reverts. The blockchain acts as if the loan literally never happened. So for the lender, there is absolutely zero default risk. Traditional finance asks if a borrower can repay years down the line. The flash loan model asks if the code can repay before the transaction is even finalized. Let's map this out step by step. Say Uniswap is slightly imbalanced, and it only takes 0.99 DAI to buy 1 USDC. First, you flash borrow 100,000 DAI from a protocol like Aave. Second, you route that to Uniswap to buy USDC at that discount, netting you 101,010 USDC. Third, you instantly route that over to Curve, where the pair is perfectly 1-to-1, and swap it back into 101,010 DAI. Fourth, you repay Aave the $100,000 principal plus their mandatory 0.09% protocol fee, so you're giving back exactly 100,090 DAI. All of this happens in milliseconds. And the absolute kicker here? This successful ledger commit leaves a mathematically precise net profit of exactly 110 DAI, safely sitting in your wallet. The entire sequence happens inside one block. If any step fails, if prices shift or the fee can't be covered, the system just reverts to state zero. It is a flawlessly controlled financial state machine. Now, I know what you're thinking. A massive reality check here. If this requires literally zero upfront capital and the math is that foolproof, why aren't we all just running flash loan scripts from a beach somewhere? Why isn't everyone rich? Well, that brings us to Section 5, Systemic Risks and Predators. Because in reality, this is a highly competitive, incredibly high-stakes game. To actually pull this off, you have to navigate three massive hurdles. First, network congestion. If gas fees spike mid-route, those network costs can easily wipe out your entire profit margin. Second, price slippage. If you're trying to swap $100,000 in a pool with really thin liquidity, the sheer size of your order is going to warp the exchange rate and you'll get way fewer tokens back than you were initially quoted. But the third hurdle? That's where you meet the ultimate predators, MEV bots, maximum extractable value. The mempool is basically a public waiting room for unconfirmed transactions. High-frequency automated bots are constantly scanning this waiting room. If a bot spots your brilliant, profitable flash loan route, it will literally copy your exact code, submit it to the miners with a slightly higher gas fee tip, and have its transaction mined right in front of yours. It's called front-running. By the time your trade actually hits, the arbitrage gap is totally gone, and they've hijacked your profit. Finally, let's wrap things up with Section 6, Bridging the Asset Divide. So how is this tech evolving beyond just crypto speculation? Well, by using stablecoins like USDC, DAI, or native platform tokens like SPBX as intermediate refineries, platforms like Secure Bankbox are creating tokenized, verifiable real-world assets. The exact same atomic smart contract technology used to flip DAI for USDC is now being applied to digitize traditional finance. We're talking about ERC-3643 permission tokens, tokenized uniform commercial code filings, and even automated insurance claims. But putting complex, illiquid assets onto an immutable ledger, institutions can drastically increase security and auditability. This literally changes the basic architecture of finance. It replaces long-term borrower trust with instant, fail-safe mathematical verification. Think about traditional credit for a second. A bank loans you capital, you go do an activity, and the bank just hopes you repay them over the next 5 years. Atomic liquidity completely flips that paradigm. Capital is loaned directly into a programmed transaction. If the transaction cannot immediately satisfy the repayment condition, the entire thing reverts. It completely separates the risks a lender is willing to accept from the risks the system is mathematically designed to reject. So, I'll leave you to ponder this final question. As Wall Street increasingly embraces tokenization, is the broader financial system actually ready for the speed and the sheer ruthlessness of atomic arbitrage? We've seen how brilliant the architecture of instant liquidity can be, effectively removing default risk for lenders. But with predatory bots constantly scanning for weakness and networks congested with high-speed algorithmic warfare, merging these two worlds is going to be the ultimate stress test for the future of money. Thanks for tuning in to this explainer.